to begin today, and before we jump into the material, I'm going to ask Ivan and Doug to tell us a little bit about both Arbor and NMHC. Ivan.
Thank you, Sam, and good afternoon to everybody. Arbor Realty Trust is a publicly traded real estate investment trust listed on the New York Stock Exchange. We're a leading lender in the multifamily space, as well as do other asset classes. We're a top 10 Fannie Mae lender and one of the leading lenders with Freddie Mac on the small balance program. We also do a significant amount of transitional loans and have a balance sheet of between $3 and $4 billion worth of transitional loans. We're very active in the mezzanine and preferred equity space as well. I'm very pleased to be here with both of you today.
Thanks very much, Ivan. Doug, can you tell us a little bit about NMHC and the work that you're doing?
Sure. NMHC is headquartered in Washington, D.C., and we represent the leadership of the trillion-dollar apartment industry in the United States. We bring together the prominent apartment owners, managers, and developers and financiers who help create thriving communities by providing apartment homes for almost 40 million Americans. We provide a forum for insight, advocacy, and action that enables both our members and the communities they serve to thrive.
And so I think for all of us in the multifamily sector, we greatly appreciate all of the work that NMHC is doing on our behalf to make sure that our concerns and views are properly expressed and articulated in D.C. It is an unusual time, certainly in D.C. and around the country. We know that people are anxious to hear about NMHC's consensus views on what 2019 is going to hold for the market. To kick us off, and as we jump into a lot of that detail, could you give us your year-end multifamily trends that you see really shaping the start of 2019?
Sure, Sam. We've been in a rising rate environment. Property owners and real estate don't like that, but the Fed has signaled they're going to do consistent step-ups. When the market began to get uneasy with that, the Fed has signaled that they are going to be a little bit more business-friendly and not do necessarily in rote fashion that they had indicated before. And despite some softening of rents, the near-term fundamentals remain pretty solid. Multifamily rents are moderating, but they're not declining in most cases. Rental demand and absorption remain strong. There has been a slight tick up in move-outs to home ownership. We can talk about that a little bit later. Apartment supply is catching up, but it still lags pretty far behind. And we're experiencing construction labor shortages that are impacting development. There is abundant debt and equity capital out there. I know that Ivan can talk about that a bit more later, and that underwriting remains conservative, as it should be. For investors, finding deals continues to be challenging, given prices, cap rates, and abundant capital from all over the world.
Yeah. So we're going to, over the course of the next hour, we're going to jump in on all of these issues in a little bit more detail. I'll just take a moment to reiterate your point about rising interest rates. I think when we got minutes from the FOMC last week, what was clear was that the Fed is cognizant of some of the downside risks to the economic expansion, some of the concerns investors and consumers have, given some of the unusual developments over the course of the last month. And as you mentioned, I think the FOMC did signal in its minutes that while they had a very prescribed path that they've been articulating perhaps in mid and late 2018, that they'll take a more cautious or measured approach in 2019. I think one of the things we'll also take a look at in a moment is that the yield curve has been and has become very, very flat. Now, while that certainly raises issues of concern for all of us, how do we read and interpret that flattening the yield curve? What it also means for us is that although the short end of the yield curve has been going up, those short-term interest rates have been rising, we have not seen a commensurate increase at the long end of the yield curve. The 10-year Treasury, the 30-year mortgage rate have not been going up, on a lockstep basis in a way that would suggest significantly higher cap rates. And so a bit of a silver lining there. There is, obviously in the multifamily sector, some specific issues around, developments in the regulatory environment. And Doug, could you outline those for us as well?
Sure, Sam. Despite predictions to the contrary, 2018 was a very good year, and we're off to a pretty good start in 2019. So what's not to like? Well, We have a housing supply and a housing affordability challenge facing us, and it overarches everything. There is a lack of cohesion at the federal level about what to do about it. In one direction, you have HUD going and tackling, as they should, the regulatory barriers that impede development and redevelopment. On the other hand, we're seeing in Congress, selected members are attacking the symptoms of the housing affordability challenge, which are rent increases, evictions, source of income, and those kind of issues. But no one at the federal, state, or local level is attacking the core problem. And so some thoughts for today are we cannot build our way out of this problem. The federal government is limited in what it can do to be a catalyst there through the low-income housing tax credit program. We really need a Marshall Plan for housing that involves building new, rehabbing, and preserving our stock. We also need increased funding at both the federal level and the state and local level for housing vouchers. And then there's a necessity for states and localities to reduce the regulatory red tape, and we can come back to this later, but that is really where the rubber meets the road, is the maze of regulatory burdens and costs at the state and local level that impede both development and redevelopment.
Yeah, one of the things I think folks are going to be interested in hearing about from you as we go through today's material is, where are you seeing, and can you cite examples for us of states and localities where they really are on the right track in terms of reducing that regulatory red tape, where we see some policy choices being made that are really beginning to benefit workforce housing renters as well. So you cite the Marshall Plan of building, rehabbing, and preserving. Tell us a little bit about what might be some of the policies that would be part of such a plan, or are there certain measures that NMHC is actively advocating for?
Well, I think not everybody's on board with the Marshall Plan to start with, but I do think I've already articulated some of the points here, and that is that we need to spend more money on a real basis. The amount of spending for housing vouchers have gone down consistently over the past decade. And it's been both parties. It hasn't been Republicans or Democrats. It's been both. We need to reduce the barriers out there. The federal government can do certain things. We're encouraging them through HUD and through perhaps an infrastructure bill that could incentivize states and localities to cut the red tape. And really use the tools that are there, principally at the state and local level, where their taxing authority, with the assets that they own, the land, the buildings they own, the regulatory environment, and the entitlement process all need to be reformed. There are some smattering of good examples out there, but like the 40B program in Massachusetts. But in the main, we're still struggling at the state and local level to have the kind of environment that will be helpful to us in meeting our challenges.
So I want to point out for folks that are listening in, a couple of questions have already rolled in with regard to some of the detail around NMHC's advocacy activity. Definitely avail yourself of the opportunity to visit NMHC's website. There will be an opportunity to ask questions at the end, but we are keeping an eye on the stream of questions as they come in over your interface. So please do go ahead and ask those as we're going through the material. One last question that I want to address up front, and then Ivan, if you can give us some of your perspectives on changes in the regulatory and policy environment as well. A couple of people have asked if they'll have access to the print materials and to a recording of the webinar after the fact, and absolutely we'll be circulating both of those. Ivan, what are you seeing on the regulatory and policy side?
Well, first is we're all aware the multifamily market is quite large. It's about a $300 billion market, and about almost half of that is being handled by Fannie Mae, Freddie Mac, and FHA. A lot of the growth in that market has been in areas that we do like, that do address affordability and certain needs. Several years ago, the FHFA instituted a scorecard, and part of the scorecard was getting the agencies to direct their behavior into areas that were much needed. It was their way of, addressing the affordability issue. And one of the key issues, which we're a major participant in, is a small balance program. Small balance program addresses workforce housing. And that's a big part of what was lacking. And the growth in the agency business, I would say the growth from what was a mid-30s% market share up to around 50 came in certain modified behavior caused by the scorecard. And the agencies are doing almost $10 billion worth of small balance loans. That's a product they weren't doing. And I would like to say that the rest of the product, it's not a profitable product for the agencies, so it's the rest of their program which is subsidizing the small balance program. So in their own way, the agencies, because the FHFA has taken that direction, has started to have some level of impact. With respect to certain local and state programs, it's not large, but it is a little bit of an effort. When developers are developing these products, they're getting certain ability with tax incentives on a local basis to add 5, 10, or 20% to their complexes by adding affordability. That has been very beneficial to both the affordability side and to developer. They're basically adding units, not costing them that much, but providing housing. So it's a small amount, but we still run into the same issue. You can't reproduce housing without the right subsidies and be able to have affordable renting. So we have a long-term problem that has to be addressed on a more global basis. You can kind of address it a little bit by little bit, but there has to be a master plan to address affordability.
Thanks. So, gentlemen, as a preamble to some of our more detailed discussion on the multifamily market and some elements of that, longer-term vision, I'm going to spend a couple minutes talking about some of what we see in the macro economy. And so, jumping ahead to a slide that illustrates where we are with real GDP in the United States. I think you can see from the Wall Street Journal Economics Survey forecast, which surveys a broad cross-section of economists. The general expectation, and you can also see this on the right-hand column, the April versus 18 versus January 19, projections. Economists are generally expecting that we will see things slow down a little bit over the next couple of years. Add in some of the sources of risk to the economy today, some of the potential drags on economic activity. Certainly foremost on our minds is the potential impact of the government shutdown if it were to be protracted, if it were to go significantly longer. The IMF released a report just yesterday, citing some of those concerns as potential sources of drags on not only the U.S. economy, but the global economy. That being said, our baseline expectation right now is that we'll continue to see growth. And as you can see in these numbers, rather than offering an individual opinion, across that broad cross-section of economists, you can see 2018 growth numbers being a little north of 3%. Right now, our expectation is that in February those will get revised down a little bit. 2019, a little bit slower at 2.2%, and 2020 at 1.7%. There is a lot of discussion in the market around the longevity of the real estate cycle, the longevity of the business cycle. We know that in modern U.S. economic history, the longest expansion we've seen is 120 months. A favorite, statistic or anecdote for economists to throw out right now is with regard to our hitting up against that 120-month number in June of 2019. I think it's important for us to reinforce, while there are some very real risks that we need to remain cognizant of, no expansion has a finite lifetime associated with it. No expansion, peters out from old age. There's always a proximate cause. And so we need to keep a close eye on what those proximate causes might be. And in particular right now, be paying attention to the drivers or the sources of drag on consumer and investment confidence in the United States. The biggest source of support we have, as you can see on the next slide, and this is sort of just one small characterization, is what's going on in the labor market. You can see the unemployment rate, the most oft-cited statistic, of course, I think we all know, is an incomplete characterization of the labor market. It's only telling us about one aspect or one metric. We've overlaid it here with initial claims, and what this does is at least tell us part of a story where the labor market remains very strong. We're seeing modest but more meaningful wage growth than we have previously in this cycle. And when we look at the numbers that show net new job creation has actually slowed down from its peak of a couple of years ago. Just a little bit of context for that. It's not that we don't have jobs open and available in the U.S. economy today. In fact, by in absolute terms, we have more jobs open and available than we've ever had in the U.S. economy. Businesses are telling us that they're having challenges filling them, that in some cases there's a gap, either a spatial or a skills gap between the kinds of jobs that are available and the skills and locations of the people that are really looking for work. But that's an important distinction. It is not the case that net hiring has slowed because businesses don't need that labor. And as Doug has already alluded to, and we'll discuss a little bit more in depth, construction is one of these areas. If hiring is a little bit slower than what the market fundamentals might suggest, in large part it's because we've got some real supply restrictions in terms of the pool of available skilled labor for both multifamily, commercial, and single-family construction. One of the small contributors we can see to that is, of course, we talk a lot about skills, but there are, as an additional element of this that we do want to keep in mind, what those lighter green bars are showing on our labor market slide, is that there is also a demographic element to this. And we do have a segment of the U.S. population that either because they're in university or college, or because they're exiting the workforce and at the end of their careers. Some element of the decline in labor force participation that we've seen over the course of the cycle is attributable to some basics around demographics. There are obviously a lot of other issues going on here, and that this is one element. So the economy overall fundamentals look healthy. We do have the political and geopolitical issues that are sources of concern. We're all watching very, very closely. And certainly for federal workers, that are due paychecks, these are very, very real issues, and they're not necessarily thinking about them just in macro terms. They're, real issues in very personal terms. When we look finally then at what's going on with those interest rates, as Doug has described, it was one of the top issues for 2019. But the Fed has signaled over the last couple of weeks a more measured approach, one that's certainly cognizant of and thoughtful of where we are in terms of the risks to the economy. When we look at the yield curve, what this chart really illustrates for us is that the Fed exerts tremendous influence over the short end of the yield curve through its policy instruments. And you can see here 2017, 18, 19, that short end of the yield curve really has moved up by something on the order of about 200 basis points. We have not seen a 200 basis point increase in the long end of the yield curve. And so there are two sides to this. The yield, sort of the slope on the yield curve is much more limited. We're looking at something now that looks like a flat yield curve, 32 basis points difference between that 1 month and that 10-year. And economists, of course, are going to be concerned about and want to read what does this mean for us in terms of the tea leaves? Are people concerned about what might happen next? Is this a sort of a harbinger of recession, as inverted yield curves typically are? Those are going to be very real concerns. I think the other side of this, of course, for all of us is that the upward pressure that we would expect from a 200 basis point increase in the 5 or the 10-year on cap rates, on borrowing costs, are not things that have been as significant as pressures on the multifamily sector as they otherwise might have been. And with that, actually, Ivan, you're seeing loans being made every day. What are you seeing in terms of the impact of interest rates, the movements in the yield curve on multifamily borrowing costs?
Well, we were seeing a rise in the 10-year, and it was approaching 350, and it was a high level of concern. I don't say there was a panic, but there was a huge amount of concern. You had many borrowers who are on variable rate loans who are now looking to get into fixed rate loans, and you were running into certain sizing. Rates dropped dramatically. The 10-year went from close to 350 down to, I think it might have gone close to 250, and now it's sitting in the 265 to 275 range. That made a significant difference. So without a question, the upward pressure on the 10-year started to create issues, and I believe it was starting to affect cap rates. So we will keep an eye on that. The variable rates now, it's a difficult option for people. You went from a LIBOR, which was 50, now into the mid-twos, and people are looking for an exit into fixed rate product. So to the extent that rates remain in this region, I think you'll see stability. If rates rise, you'll see some instability. So we will keep a close eye on that. But borrowers are very much attuned to that. especially when you have low cap rates, and any significant movement on the long end of the curve will affect borrower returns.
Yeah. So a couple of other questions have come in about the availability of both the recording and the materials from today, and both of those will be made available. If folks, we do have a large number of questions coming in. If we don't get to yours over the course of our conversation, someone from the team will follow up offline to make sure that we have a chance to respond. Ivan, one quick follow-up question on your point. Have you seen any shift in long-term versus relatively shorter-term financing options in the market?
Well, I think when you have a flattening of the yield curve and the differential between now the variable rate, which is very close to the fixed rate, there'll be a tendency to go to fixed rate. What we're seeing, though, is when the 10 and the 12 and the 15-year products are only 5 to 10 basis points apart, you're seeing people go longer term. So we're doing more 12-year loans than we've ever done before. So borrowers are saying, well, rates may go up 2, 3, 4 years from now. Let's get as long a duration as we can in today's current interest rate environment. And furthermore, with the products that we offer, the longer duration you have, many borrowers recognize that you're able to take out a supplemental loan to your existing loan, so they're able to take advantage of a longer product, and rather than refinance their whole product, they can take out additional cash as the NOI in their products grow in the value of their asset. So the tendency is to go as long-term as they can.
Great. Thanks, Ivan. We're going to actually take a moment for a quick audience poll question. The question is, how likely is a recession if the Treasury yield curve were to invert? The only thing that I'll offer as a point of clarification here is that the inversion of inversion of a Treasury yield curve is not causally related to a downturn. It's not that an inversion serves as the proximate cause for then a slowdown in the economy. The question is really asking here about whether or not inversion of the yield curve at this point in time would be a strong indicator for us of a downturn ahead. And so take a moment to just answer this question. We're actually, during the Q&A section at the end of today's presentation, going to come back to the results to see what folks thought. And we'll contrast that with the results that we got from economists as part of the Wall Street Journal's monthly forecast. This is a question that they put to economists just this month. So going to take a couple of seconds for that. We've got all of our answers rolling in. About 50% of people have now voted. We're going to give it another 30 seconds. Then we're going to jump into some material on real estate investment trends and look at what's happening with investment and lending activity. Certainly people have questions about cap rates as well. So if you take a look at this next chart, what you can see is that we've got multifamily cap rates and 10-year treasuries that have not necessarily been moving together in lockstep. And I think that's an important point that folks in the industry are going to make, which is that it's not necessarily the case that over any relatively short period of time, these things are going to be moving together. What you've got is treasury yields that are going higher, cap rates that have, depending on the market and segment of the market, either remained steady or have continued to trend down, albeit at a slower pace than they had been previously in the cycle. That spread is at the low end of the range that we've seen over the course of this expansion. And so that is something for us to keep in mind, that there has been some meaningful cap rate compression, and there may not be as much room for further compression as would have been the case 3 or 4 years ago when those spreads were wider. Ivan, tell us a little bit about what you're seeing in this space as well.
Well, when rates were rising, people were thinking there'd be a commensurate rise in cap rates. And I think rates went up very quickly. They settled back down. But the other factors you have to look at are rent growth. We continue to have rent growth. So cap rates are also a function of rent growth and growth in real estate and alternative investments. So when you had instability in the stock market and you had signs of continued rent growth, you didn't see a rise in the cap rates because that was sort of an offset. And if people believe that rents will continue to rise, which is also a factor of wage growth, I think you'll see cap rates remain tight, even if there's a little bit of movement in interest rates on the upward side.
Doug?
Yeah, I think one thing to keep in mind is that multifamily has been the darling of the real estate sector for about 5 years running. And there's a wall of capital out there that's wanted to be invested in it, in some cases frustrated because they couldn't invest in it, but waiting to invest in it. The big question is, what will happen with the pecking order in the next 2 to 3 years with industrial and so on? Will multifamily remain as favored an asset class as it has been? That has had a big effect on cap rates.
Yeah, and I'll elaborate on that a little bit as well. We look at it from an economist perspective in terms of measures that we refer to as sort of lender and investor density. So what we're looking at there is measures of liquidity. How many investors are in the market for every investable opportunity? How many lenders are in a particular market relative to the number of opportunities to be originating a loan? And what we see is that the multifamily sector, both on the investor and lender side, is characterized by a greater level of liquidity than any of the other commercial property types, and that certainly was very apparent in the early stages of the recovery. Doug, you raise a good point. Multifamily has been the darling of the industry. Certainly, industrial has captured the imagination of a lot of folks as well that have seen that we're fundamentally just moving more packages around than we ever have before. On the multifamily side, we need more place to store them when they arrive in our buildings until tenants pick them up. On the lending volume side, this is data as of the third quarter from the Mortgage Bankers Association. And we can see here that, year over year in the third quarters was, to an even greater extent than in the second, we continue to see increases in MBA's measures of multifamily originations. Ivan, how does this sync up with what you're seeing on the ground?
Well, the origination side is extremely aggressive, and the market continues to grow. And as I mentioned earlier, the agencies maintain a very large percentage. I think that one of the factors where you're seeing a good percentage of originations, there were a lot of loans done over the last 5 years that were 5-year maturities, and a lot of variable rate loans that have even shorter maturities. So you're seeing many loans that were made only 3, 4, 5 years ago come back to the market for refinance opportunities. So we're very bullish on the size of the market, and we're very bullish on the agency share of that market. So it's very attractive, but very competitive.
Yeah. On the next slide, one of the things that we do is to break it out to show what's happening with multifamily cap rates overall, and then those that are funded as part of a small balance program. What we can see here is that if you were to go all the way back to 2006 and 2007, you'd see that spread in cap rates between the small balance and the multifamily market overall really suggested that there had been meaningful erosion of risk pricing. That the big asset in New York or DC that have been characterized by a lot of liquidity, some fairly aggressive investment activity, was not differentiated significantly, at least as measured by cap rates, from the smaller property in a secondary or tertiary market. As you'd expect, an exaggerated reaction once the market as a whole had really become very conscious of economy-wide risks, and that spread expanded out to 120 basis points. Given the selection bias in what could get financed, that's even the numbers otherwise would even be a little bit wider. Right now, when we're looking at small balance, and both Ivan and Doug and I will chat a little bit about the importance of small balance for the workforce housing segment and for addressing some of the affordability constraints in the market. Remains at levels that I can say, from an economist's perspective, I'm comfortable with. We're at about 74 or 75 basis points, and these are numbers that go right through the fourth quarter of 2018, subject to some revision, but overall we're seeing that those spreads remain fairly healthy. I mean, what are you seeing in terms of the level of compression here?
So clearly the opportunity for people to buy small balance loans has become easier because the financing has become more commoditized. In the past, it was very fractured. You didn't know where to get a loan. You didn't know what the process was. And given the size of the transaction costs were very expensive. So I believe over the last 3 to 5 years, with Freddie Mac developing their small balance program, it's reduced costs, it's consistency, and it's reliability. And the same person who would typically buy a $25 million property, they don't mind buying $5 million properties because they can finance them, run them easily, and it's not such a complicated process. So I believe that those spreads will probably tighten up a little bit and remain consistent, and there won't be that much of a variance.
Yeah. When we take a look at, you mentioned the agency several times, on our next slide, what we see happening with different sources of capital, it's not going to come as too much of a surprise to folks that, CMBS has been flat to slightly declining in terms of the way in which it serves as a source of financing to multifamily. This other segment, which is very, very broad, it includes everything from the largest private equity sources of capital to sort of more informal lending markets. In multifamily has not been sort of a major contributor to growth, but banks, life companies, and most importantly agencies have been the real drivers of these continued improvements in liquidity. In terms of what that's translated into, folks can see on the right-hand side of this page, certainly do have more multifamily debt outstanding today than has been the case historically. But Ivan, could you give us a little bit of context around the relative importance of these different sources of capital and continuing to support the market?
Sure. First of all, there is more debt outstanding because values have gone up dramatically. So just based on the fact that multifamily values have probably doubled in the last 10 years, you're going to have double the amount of outstanding debt. When you look at the amount of debt the agencies have outstanding, that's also a factor that they have longer term debt. So their average duration is probably twice as much as what the banks are. Banks are typically 5-year product lenders where the agencies are 10 years. So they're going to have a greater percentage outstanding just by the fact that their duration. But clearly, the agencies have grown dramatically. The banks still are very good lenders. We all know that the CMBS multifamily sector has decreased dramatically since '07, and for good reason. And I think that the agencies have provided a very good solution for multifamily lending across the board.
Yeah. When we look at sort of how bank lenders in particular are feeling about where they sit, you can see on this next slide from the Senior Loan Officer Opinion Survey, I think there had been a period of time in 16 and 17 where bank lenders that are being surveyed by the Fed, and whether it be because of concerns around the potential for a slowdown in rent growth, about the impact of new supply coming online, had signaled as part of the survey that they were tightening up a little bit on standards. I always take the survey with a grain of salt because I think the folks that are responding to the questions know who the primary readership is and what that readership's concerns might be. But I think what's sort of helpful for us now is to see that in the most recent set of surveys, and my team sees this in the ones that we conduct with the Real Estate Lenders Association as well. Lenders in the market are feeling that we're about where we should be, and concerns about our being overly aggressive in multifamily lending, are not the order of the day. Ivan, how do you see the market feeling today about the way in which money is being put out?
I think the market is extremely competitive, very sophisticated and aggressive, and there's a lot of liquidity. But we're experiencing unprecedented rent growth, and no matter how aggressive you've been over the last several years, the rent growth has made everybody look very good despite how aggressive they have been. So I would say proceed with caution. If there's a flattening of rents, if there's a dip in occupancy, then we have to really pause. But as long as you're going to see rent growth in the 4 to 5% and occupancy remain at this level, I think that the current underwriting standards are okay. We definitely caution IO because when people come off IO and you have flat rent growth, it becomes a little bit difficult, especially if you have that expectation on investor returns. So I would say at this point, as long as there's consistent rent growth, the underwriting standards are fine. If there's slowdown in rents, I think we should make some adjustments.
Yeah. Doug, you're talking to everyone in the market. I know you had sort of raised this in your opening comments. Could you elaborate a little bit? What are folks' expectations around rent growth as we look forward to 2019?
I think most people are looking for a flattening, frankly, a slowdown. There are certain markets that are still so red hot in terms of producing jobs, like Seattle and Dallas, for example, and markets that are recovering so strongly, like Las Vegas and Phoenix and Orlando. where you're going to continue to see rent growth because there's so much demand for this kind of housing. But on a national basis, I would think that we're going to continue to see a slowdown in rent growth. I'm not saying a drop, I'm saying a slowdown in growth. And if you think about what the millennials are facing today, the most recent data I saw says that the student debt outstanding and the amount per person has gone up. There's still a lack of product out there to buy for them, and they are more mobile and more urban than preceding generations. So I think there's not going to be much of a let up on the demand side. So we will continue to see some growth, but it will be slower.
Ivan?
Yeah, I would just, I agree with that, Doug, but one thing we watch for is if there is a flattening of rents, you really have to take a look at occupancy, because then you have an exponential effect. So if you have flat rents and a dip in occupancy, then you create a high level of concern, because there's one thing to maintain your occupancy, but when you drop your occupancy and you don't have growth, then you start to have credit issues.
Yeah. One of the listeners on today's call is correctly pointed out that we do see sometimes significant variation in rent growth, occupancy rates across a whole bunch of different dimensions. And when we're looking at relatively more affordable space and small properties, perhaps, versus that core urban downtown luxury high-rise Class A building, both in terms of the supply side, but also in terms of the actual rent growth trajectories. Outcomes may be very different. And we're actually going to talk a little bit more about affordability in a moment. But to listeners, I'd be remiss if I did not pass along the point which has been very correctly raised when we're looking at these different segments of the market. And sometimes you can see it broken out in terms of data and trends on what's happening with rents for Class A multifamily versus B and C, where there may be location issues around where A is versus BC, what's been built and how much of it has been what we would think of as A versus BC. And certainly when we're looking at small balance and relatively small properties, what are the demographics there? Who's living in the studio and one-bedroom apartment in the Class A high-rise downtown versus what is the demand profile for that relatively smaller property? If those are questions that folks are interested in that we don't get to today, on Arbor's website in the chapter section where the research is published, you'll see that we're doing a lot of work there on breaking down the demographics and demand profile for renters across all of these different segments. When we do talk about then jump in a little bit further on affordability, Doug, this next slide illustrates how there's been this difference, and it's one that's sort of been sustained over quite a while between what's happening with people's incomes and what's happening with the rents that they're paying, again, at the highest level. What are the headwinds to affordability right now?
Sam, I think as you know, I mean, up until very recently, from basically the mid-'80s on, the middle class didn't have a wage increase on a real basis. And so stagnant incomes have been the principal force affecting affordability. Added to that, we, up until very, very recently, again, we're not supplying enough housing. And that, by the way, goes for both single-family houses and apartments. Just not enough supply coming onto the marketplace. And then we've had, as I mentioned earlier, we've had a cutback on a real basis on federal vouchers for housing. There really isn't much at the state and local level, although they're starting to experiment there. And then at the state and local level, you're getting so much political obstruction, if I will call it that. There's a maze of regulation on land use and housing, all kinds of policies, the co-location of residential and multifamily and so on. And there's also a lack of political will to tackle the problem. The people who scream the loudest are those who get the attention, and therefore they're focused on the symptoms of the problem, as I mentioned earlier. If rent increases have been going up or people have been getting evicted, then they're focusing on those and not the core problem. The NIMBYs are getting more and more creative on designating areas as historical or whatever, and trying to block development or redevelopment. And then a final factor is what we call the naturally occurring affordable housing has been increasingly getting scooped up by institutional capital, and the nonprofits and the governments can't compete with all cash deals that are happening out there, and so that stock's going away. We lose somewhere between 100 and 125,000 units at the very bottom end of the market every year. So that naturally occurring affordable housing and the natural loss of stock are taking all of the bottom end of the market out in their effect. And so all of those are working together to create a problem for us that we have to tackle.
Doug, the next slide is about illustrating the relative severity of the problem across some of the largest cities. As a lead into that, we've got a couple of folks that have chimed in through questions about why their particular market hasn't appeared on the list of markets with the fastest growing rents. And without getting into each specific one, what I will suggest is that in some cases there's tremendous variation. So it may be the case that in the urban core of a market, there's very, very rapid rent growth. And that's what we tend to sort of focus on in thinking about that market. But when we look at the larger metropolitan area, wherever our geography is defined, there may be large swaths of that geography where rent growth is more modest. It may also be the case that in some markets, a significant share of the supply is rent controlled or rent stabilized, and that may be limiting the overall measure of how much rents are growing because of an artificial or regulatory or policy constraint on the rent growth. That being said, in answer to some of the questions that have come up about why my market isn't on the list, Doug, tell us about this measure of income needed to pay rent.
Sure. There are a couple of slides that we'll talk about here. This first one, you have to look at the combination of stagnant income growth, restrictions on multifamily activity, and a lack of new apartments being brought on the market, and they've created a perfect storm of increasing rents that are out of the reach of an increasing number of middle-class renters. So if we want to just go to the next slide, if we could, that really shows, another way of looking at this is how many hours would a person have to work, assuming a minimum wage. In this top case, it uses $7.25 an hour. How many hours would they have to work to afford a 1 or 2 bedroom apartment? Even at double that wage, if you go to $15 an hour, it is still increasingly out of reach for the middle class, the teachers and the firefighters and the policemen and the hospital workers to afford even a 1 bedroom apartment, let alone a 2. So this is what we're dealing with right now and so the policymakers look at that and they immediately assume that the problem is with the owners and the landlords just jacking rents up at will, not understanding that landlords and owners don't set market prices, the market sets them. But unfortunately, they then put the blame toward the landlords and owners, not toward the real core problem, which is just not building enough, not providing enough subsidy to people who need it to afford the rents. And so, we've got a perfect storm going.
Yeah. Doug has pointed out that when we think about the range of solutions and what might constitute part of the a Marshall Plan, so to speak, that supply on its own is not an entire solution. That being said, we have seen some real upward pressure on construction costs that have played a role in limiting new supply in the market. I wonder if you could tell us a little bit about what you're seeing there.
So it turns out that we have a case in hand. We're doing a development in an opportunity zone down in Phoenix, and we had estimates from 6 to 9 months ago, and we were prepared to begin construction. And it got so busy in Phoenix, and there's so much construction that they had a significant change to the budget, which significantly changed our IRRs, and we don't even know if we can do the project at this point. So there's an enormous amount of pressure on construction costs that's going to affect the ability to deliver products in an affordable fashion. So it gets back to the initial concept that Doug was talking about. We cannot, without a plan, deliver the kind of affordable housing that this country needs. We can do it on a bit-by-bit basis, but that doesn't solve the overall problem.
Yeah, and you can see on this next slide with absorptions and completions, and this is data from Reese, that we've not seen in the sort of, really sort of dovetails with the point that Doug had made earlier. While there was some drop-off in absorption between 16 and 17, no real diminishment here in terms of demand. And I think, there'll obviously be some ups and downs from year to year, but when we look at the demographics, when we look at the socioeconomics, when we look at the relative preferences and capacities for homeowning versus renting, the multifamily demand in the United States and driving as a driver of absorption, continues to look strong even as these completions tick up. And we sort of in our data on starts and projects underway really see are having reached sort of the peak of that completion cycle, at least for now.
But you are seeing a little bit of a transition. I mean, we haven't spoken about it, but I will mention the single-family rental market is addressing the affordability issue. So the single-family rental market is as big as the multifamily market as we know it, and is growing more rapidly than the multifamily market. And as it turns out, that the affordability issue is being addressed in that sector of the market.
Yeah. If you're looking for the legend on this slide for what these greens and oranges mean, take a look at the just below the x-axis of the chart. On this point of the rental supply, growing, but not really keeping up with our long-term expectations for demand. Doug, walk us through what we've got on this slide over here.
Sure. A couple of years ago, we were looking at, longer-term trends. Is this really going to be such a robust rental market going forward? I said, let's go to a reputable research firm and let the chips fall where they may. We went to Hoyt Associates, and they did a phenomenal job for us. And what we found is that through the year 2030, we're going to need 4.6 million apartments just because of the changing demographics in the country and changing lifestyles. And if you just take a look at the top MSAs and you add those up on the right-hand side, that's 1.8 million new units we're going to need in just those top metro areas. So I continue to believe that we're going to have very strong demand, and we're going to need somewhere close to 330,000 units delivered into the marketplace every year just to meet this demand. And we have met that number once or twice in the past 20 some odd years. So it's a daunting challenge for us all.
Yeah. Certainly good news for folks that are concerned about the potential for our building too much. What I will add as a point there is that, certainly we will encounter situations, Doug, where there might be localized sort of supply imbalances. There might be an urban core in a particular metro area where we might build too much class, or I should say too much, but there might be an imbalance between the near to medium term demand for Class A luxury studio apartments. But when we look at this in the aggregate, we're not seeing numbers that are really off base. Is that fair?
Yes, that's correct.
So a big part of these imbalances does come back to our conversation around the relative affordability of renting in the United States and the role that workforce housing, however loosely or narrowly defined, plays in helping to address that need. So the next question, if I can turn it over to you, Ivan, we could mean a lot of different things when we talk about workforce housing. Broadly, what does it mean for us?
So when I think of workforce housing, and I think when most people think of it, they think about the policemen, the teachers, the nurses, the people who have those kind of steady jobs, who are looking for homes. They're not looking for amenity buildings. They're looking at places to raise their family in a community and to have a place to rent that provides a nice home for their family. And that's kind of how we look at it. It's generally B and C type properties. It's often 2 to 4 family type properties, but it's generally B and C type assets without amenities.
Yeah, and probably an important point to add to that in your discussion of families is that when we think about the amenity set, it may not be the case that there are amenities that are internal to the property, but in terms of the amenities that property gives you access to by virtue of its location. Things that like a public transportation hub that give you access to employment opportunities. Perhaps most importantly for many young families, a location where the amenity again may not be internal to the property, but the amenity that you get access to with that home is access to a good quality public school. Critically important amenity for that young family as well. It's a big part of the workforce housing story. On the next slide, Ivan, it describes the role that small apartment buildings play in this. And some of it has to do with amenities, but what is the connection here? What's the correlation between workforce and relatively smaller properties ultimately that are benefiting from some of the small balance lending programs?
So what we're seeing is two things. First of all, I didn't mention it, but generally the people who are workforce housing, they tend to stay in the apartments longer. They don't move around as much. They're not as transient. They're not looking to move from city to city. Sam, you're correct. They're looking for schools, public transportation, ease of moving around. The school systems are critical. They're looking for apartments that are a little bit bigger so they can have a family, so they don't have to jump from one apartment to the other. So those are very, very typical. They're not amenity driven. They're more logistics driven.
And when we want to size this out, so I think in the institutional market, so much of our focus is on that large urban building. Certainly, that's a part of the market that is captured for a lot of us our attention over the course of this expansion. Thinking about that millennial who does want access to the amenities. How large is the workforce housing rental segment of the market?
I don't have the number in front of me, Sam. Perhaps you have the data a little bit, but it's a very stable part of the market. You'll see with the millennials and other people, they move around a lot. Their jobs move around. Workforce housing, the jobs are more steady. The people who are teachers, who are policemen, they're not jumping around from town to town. They want to stay steady, stay in the same area, raise their children. Their jobs don't change as much, whereas the millennials are moving around. They're going from city to city, place to place, community to community. It's a very different set of individual renters.
Yeah. So just as a reminder to folks that we've got through the system, you can pose questions, and we have a large number that have rolled in. In just a couple of minutes, we're going to go to spend our last 10 minutes on Q&A. Before we do that, we're actually going to look at the results of the poll. But as a final point on workforce, Doug, have you seen the industry's conversation, the focus of investors and developers? Is workforce, as a segment of this market, does it have a higher level of visibility and awareness in our industry than it did a couple of years ago?
Oh, totally, Sam. I mean, I think institutional investors were disdainful of this segment in years past. I think when you look carefully, you peel this onion, you see that this type of housing is typically 100% occupied with a waiting list, and the returns are quite competitive. There are really, as Ivan mentioned earlier, the turn costs are minimal because people are staying in these apartments. The ones that have 2- and 3-bedroom units as a major part of their configuration are very, very desired, particularly with the external amenities you mentioned earlier. So I think all of a sudden institutional capital is saying, whoa, wait a minute, we've got 100% occupancy, waiting lists, very strong fundamentals, and returns for investors are as competitive as they can be. So I think people are waking up to the fact that this is quite attractive. And I will include in that institutional capital and sovereign capital coming from outside the United States. In a couple of my trips to Australia and Israel, they were very interested in this sector of our housing market.
Yeah, and I'll second that. I was just in Tel Aviv over the weekend, and the level of interest in this segment of the market, is palpable. You really are hearing it from people in conversation. We're gonna, before we jump into that final part of Q&A, I'm gonna take a look at the results of the poll. And I misspoke earlier. It was not a question that the Wall Street Journal posted to its economists last month. It was actually from September. But what's interesting here is the degree of similarity in the results from our listenership today. And we have a much, much larger number of people on this call than the Wall Street Journal forecasts every month. But the Wall Street Journal forecast, we had about 76 to 77% of the forecasted economists who believed that an inversion of the yield curve was either a very or somewhat likely signal of a downturn. In our poll, we have 71%. So when we look at the distribution, it's as close as we might get. Now, again, as an economist, I'll say that there's no causal relationship here. It's not that an inversion of the yield curve will somehow act as the proximate cause for a downturn. It's a question of how we interpret what is the market signaling to us when we get these interest rate outcomes. At a minimum, what today's responses are telling us is that we do need to continue to pay close attention. And if the yield curve were to flatten further, if it were to invert, we need to be cognizant of it, and we need to be asking some careful questions about, okay, well, what is the ultimate driver here? What is it that the market is seeing or is concerned about? Or what are the market's expectations that are actually driving these levels? And the better we can understand that, the better we can position ourselves defensively for whatever it is that the market might have in store for us, the macro economy might have in store for us over the course of the next couple of years. So again, the first question that's come back in a couple of times is about the availability of material. And of course, both the replay and the slides will be available. One question that folks on the call have is, and Ivan, if I can put this to you, Doug and I have both commented on some of the non-U.S. sources of capital that have a real interest in workforce. Some of the listeners asking about, if they've got equity themselves, how do they tap into the debt side of the capital markets to finance their investments in workforce?
Sure. So as I mentioned earlier, workforce housing, small balance lending, it's become a very commoditized product, very reliable. So we offer small balance loans. We're a leading small balance lender. It's very reliable and very consistent. So if you go buy a multifamily product, and that's generally 5 to 50 units in the small balance side, and you want to understand how to size that and how much debt you can do, it's very easy to do that through Arbor and through our automated process called Alex. You can go online, you can size your loan and understand how much you can borrow fairly easily. So it's becoming easy to do, easier to access the debt markets on that side.
Yeah. Doug, you're right in the thick of it down in D.C. One of the questions that's come up a couple of times is the government shutdown impacting the operation of the agencies in a way that would be material for any of our thinking about the near medium term for multifamily?
I haven't heard that, Sam. What I have heard is that some of the work that people had hoped to do on opportunity zones has been delayed simply because the number of workers who were supposed to have been available to help people through this process are not there now.
Yeah.
We're seeing ripple. Go ahead.
No, please continue.
We're seeing a ripple effect, throughout the economy here. Metro ridership is down, and people are now facing the prospect of defaulting on their mortgages. People are facing the possibility of getting an eviction notice. I hope that doesn't happen very often, if it at all, with these workers, because this is, they haven't about Freddie and Fannie or FHA being able to handle the volumes.
So on the Fannie and Freddie side, there are no issues. On the FHA side, there are definitely issues there. So those government workers are on furlough, and that is causing a slowdown to what is already a very slow process. So that is impacted.
Yeah. Well, it's certainly encouraging to hear that Fannie and Freddie are moving apace. And Doug, to your point about opportunity zones, one of the hottest topics, in the market the last few months. I've also heard that many investors have been waiting on clarification around exactly how opportunity zones will work, and some of the guidance that they were expecting to come through late January, early February. It certainly doesn't seem like that will happen, and so and then that's material given the relatively short time frame to take full advantage of the opportunity zone program. We are out of time. There are a whole bunch of questions that we didn't get to on today's call, but someone from the Arbor team will be following up to make sure that everyone does get an answer to their question. As a closing point, I'll just direct everyone again to Arbor Chatter, Arbor's news, research, trends, and insights section of its website. There you can find a whole range of regular reporting on what's happening, in particular with the small balance and small property segments of the multifamily market. And through Shannon Economics' relationship with Arbor, we've also been delighted to now introduce the first in a series of reports on what's going on in the large loan market as well. You've seen a preview of some of our fourth quarter small balance data in today's slides as well, so please keep an eye out for that. If you're looking for Arbor or how to get to the site, the contact information there is included on the last slide in the deck. But with that, I will offer my very sincere thanks to my panelists today. I think it's been incredibly informative and a great way to kick off the year for the multifamily sector. Ivan Kaufman, Chairman, President, and CEO of Arbor Realty Trust, and Doug Bibby, President of the National Multifamily Housing Council. Doug, thanks so much for taking the time to do this, especially right ahead of NMHC's very, very big meeting just a couple of days away. Gentlemen, thank you, and to all of our listeners as well.